Hello, I'm Jessica Amir, market analyst with Bell Direct. The average age of a person running their own self-managed super fund has dropped from 58 to 45 in just 3 years. And since the pandemic, there's been a marked increase in SMSFs opening as well because people are taking a more active control in their super, from picking their own Aussie shares to buying international brands that they know and use on a daily basis. Now, these are just some of the trends that have emerged in SMSFs. And to tell us more is SMSF expert Olivia Long. Olivia, thanks for coming in.
You're welcome, Jess.
This space is evolving so quickly, but what are the key trends that are really standing out to you, Olivia?
Okay, so the good news is that the establishment and running costs of SMSFs are considerably lower than where they were, say, 10 years ago, which makes running your own self-managed super fund far more viable for more people. So we've seen SMSFs up 15% over the past 5 years, and in fact, the June 2020 quarter saw the highest volume of new SMSFs established since 2015-16. We're seeing increased contributions into the sector with more people investing via their superannuation fund, with an increased exposure to Aussie equities as well. But really we're seeing people become more engaged with their retirement savings than ever, which is a wonderful thing.
In 2020, interest in the stock market hit an all-time high, with investors using volatility as their friend and buying the dip. Now, this interest is translated to SMSFs as well.
Yeah, absolutely. The number one reason traditionally that people do establish self-managed super funds is for that control. But at the moment, more so than ever, people are wanting to take that control because they simply don't know where their superannuation's invested when they're with a retail or an industry fund. With a self-managed super fund, you determine when, where and how you invest your superannuation money. You determine what assets you want to hold your fund in, you determine the underlying investments, and if you want to be really hands-on, you even actually make the underlying investments yourself. So when people are more engaged with their funds and they have that level of control, it seems less risky than when you leave it to somebody else to look after. So self-managed super funds are the only superannuation vehicle where you can invest in direct property or gold, which is really popular at the moment. And during periods of market uncertainty, some people simply like the tangible nature that those assets can provide.
There's definitely a lot more flexibility with having a self-managed super fund, and investment choice is one of those key benefits. But what are some other benefits that stand out?
But one of the key benefits of superannuation in general is that it's one of the most tax-effective vehicles in Australia. So when you're accumulating your wealth, any capital gains or income is taxed at a maximum of 15%, which is quite low, right? But when you move into pension mode, you move into an entirely tax-free environment up to the first $1.6 million. Now, SMSFs and pension funds in particular also benefit from any franking credits that are associated to direct Aussie equities that they might be invested in. So many of our pension funds actually receive a refund check from the ATO every year. Now, if you're preparing for your financial future and you're planning your retirement savings, wouldn't it make sense to do it in the most tax-effective manner available to you?
Yeah, definitely. But what about those who aren't planning retirement just yet and they aren't in pension phase? What should they be considering?
Okay, so a key tip I can give you is to consider superannuation splitting. So say you've got two people, one's 5 years older than the other, consider splitting your super to the older member in the fund, and consider making any additional contributions to the older member also. What this does is not only get that balance into the tax-free environment more quickly, but it also gives you more flexibility about deciding when you're ready to retire, because you can access your retirement savings far more sooner. Another strategy is to consider registering an SMSF for GST. So where a fund is registered for GST, you can claim back 75% of the GST on ongoing advisor management fees, administration costs and brokerage. So for those aged 60 or above, consider starting a pension as soon as you're able to. Now, the benefit of this is that you get your member balance into that tax-free environment more quickly. If you don't actually need the pension drawings and you're eligible, you can actually just recontribute them into the fund. Another strategy for those that have already retired that is relatively new to SMSFs is the downsizer contribution. So if you're age 65 or over and you sell the family home, you're now eligible to contribute an additional $300,000 per member into your fund above existing contribution limits, which is a nice way to top up your retirement savings when you've already retired.
So there's so many benefits to having a self-managed super fund, from investment choice to tax minimisation, regardless of your age. So Olivia Long, thank you so much for coming in.
You're very welcome, Jess. If anyone wants to talk about establishing an SMSF or find out more about transferring an existing fund to us, they can just give us a call.